All right, everybody. Thank you for joining us on today's December 2023 LARC webinar. We've got a little over 200 people online now, so we're going to go ahead and get started. For those of you that don't know me, my name is Ryan Melliker. I am the president and co-founder of Lodging Analytics Research and Consulting. Before we jump into the presentation, I just want to share a few different things with you. First of all, hearty happy holidays to everybody online. Hope you guys have a great holiday season, whatever you celebrate. Just hope you enjoy it. Number two is these slides will be sent out to everybody that logs in. So don't worry, you don't have to ask for the slide deck. The slide deck will go to you. My guess is I would get asked that question multiple times today, but that's okay. Third thing that I'll highlight is you guys are probably all familiar with Zoom now. There's a little Q&A button on the Zoom taskbar. We are going to hold Q&A at the end of the presentation. So we're going to try to dive into every question that we can, while also trying to be cognizant of everybody's time. So if we don't get to your question, it's not anything personal, I promise. Just shoot us an email at information@LARC Analytics, LARC Analytics.com, and we'll respond to you. With that being said, we're excited to share our current outlook. We've got a lot of interesting data in this presentation. A few things that are a little bit new and different than what we've shown in the past, but I think it'll be pretty helpful, and hopefully you will all find it relatively insightful. With that being said, we're going to go ahead and jump right in. So first, this is our backdrop. We're going to walk through kind of where we've been. We're going to move forward to kind of our economic outlook with a real focus on the different demand segments and what's driving the different demand segments going forward, which translates into our forecast for the top line, followed by our forecast for the bottom line and for values. And then we'll get into our market outlook. And then we'll dig deeper into a handful of markets that we focus on, that we get a lot of inquiries on, that we think you guys might find helpful, leveraging our GIS application. So with that being said, let's dig in. So many of you have probably seen this chart before. This chart just shows you the 3-month moving average change in occupancy, ADR, and RevPAR relative to pre-pandemic levels. What we want to highlight here are a couple of points. Number one is in April, so before the summer, ADR was 18% above 2019 levels and RevPAR was 12% above them. But the recovery kind of paused from April to August. In August, ADR was 16% above 2019 levels and RevPAR was 8% above them. So we saw a bit of a pullback there. And that's kind of what you see here, you know, where things didn't start to grow, they started to decline a little bit. And then things started to pick back up again in September, October. September was actually the best month we've seen relative to 2019 on the September 23 versus September 19, up 21% on ADR, up 20% on RevPAR, and just 1% below September 2019 occupancy levels. October was the second best month we've seen. So we started to see things bounce back a little bit, you know, post-summer. A lot of that's tied to the general seasonal shifts that we tend to see. Summer is very leisure oriented, and when you get into the fall, things start to change to be much more corporate and group oriented and much less leisure. Many of you have probably seen some of the challenges that the leisure segment has faced over the past few months. We're going to talk at great length about that, as well as where we think things are going. But I think that just gives you kind of a good backdrop of where we are today in terms of recovery expansion. But it hasn't been the same for every market, right? This is a look at our 2023 forecast for RevPAR relative to 2019 across all markets, all 61 markets that we do forecasts for on a quarterly basis. You know, basically the US, we estimate, would be about 14% above 2019 levels this year. 55 of our 61 markets are going to be above 2019 levels this year, and about half of them, 28, will be above the national average. But the market divergence remains extreme. We've got 5 markets that will be 30% above 2019 levels in RevPAR this year. And then you have markets like San Francisco and San Jose, which are still down 25% versus 2019. So you do see a pretty wide divergence. You can see there's been clearly winners versus losers coming out of the pandemic. Not everybody's created equally, and we're going to talk a lot more about that and how to figure out which markets you want to play in going forward. When we think about TSA throughput, and this is kind of interesting because I think it kind of highlights some of the dynamics that's been going on this year related to travel. This is a 30-day moving average of air traffic volumes, right? TSA throughput, beginning this year, but relative to 2019. And what you're seeing is basically things were pretty strong, going into, basically mid to late February, things were pretty strong. But then as that regional banking difficulties emerged in February and March, things started to pull back. And they pulled back pretty materially in the month or so that followed. And then it's been a kind of gradual recovery, basically all the way through August. And then you started to see things really start to pick back up, similar to what I just showed you related to occupancy, right? Relative to 2019. We started to see things improve in the fall, and that's exactly what this data from TSA throughput is pointing to. In fact, since September, the 30-day moving average for throughput has been about 4.5% above 2019 levels. So you've got more people flying today than you had pre-pandemic. While that's exciting, it hasn't really translated into occupancy. If you go back and take a look at our occupancy recovery, this kind of shows you from peak to peak where occupancy has been versus where it's going, really where it's been versus past cycles. And what we're basically showing you here is that obviously the fall off was pretty steep for occupancy. It came back pretty aggressively, but things have started to level off. Following the great financial crisis, it took 81 months for trailing 12-month occupancy to recover to the prior peak. Following 9/11, it was 65 months. As of October, we've been through 53 months, and we're still on a trailing 12-month basis, 4.4% below prior peak levels. And as I showed you before, we have not reached 2019 levels on an absolute occupancy basis. So you're still encountering a lot of those challenges, despite the fact that TSA throughput is higher. So just interesting dynamics. Some of those components are supply related. Other components are length of stay. But just interesting to pay attention to that. And then from an ADR perspective, ADR, the recovery obviously has been much stronger. Part of that is fueled by inflation, which has been more elevated than we've seen in past recoveries. But this cycle, we reached on a trailing 12-month basis, the U.S. industry reached prior peak ADR in March of 2022. That was month 25. It took 52 months after the great financial crisis and 45 months after 9/11. But as you can see, things are starting to plateau now, and RevPAR, similar metrics. Basically, in July of 2022, we reached prior peak RevPAR levels, again, on a nominal basis. That was month 29. Compare that to after 9/11, it took 52 months. And after the great financial crisis, it took 59 months. As of October, we're at month 44, and we're 12.7% above the prior peak on a trailing 12-month basis. Now, when we think about values, I think what we like to highlight here is that following the great financial crisis, values dropped about 27% from the 2007 peak right here to the 2009 trough. Values then grew back to the peak. They reached the prior peak of 2007 in 2015, and then continued to grow on from there, up another 18%. This cycle, values began declining prior to the pandemic in 2019. And then we estimate they dropped 23% in 2020, and then snapped back in 2021 and 2022 to almost get back to 2019 levels. We'll talk a little bit about where they're going to go from here. Now we're going to shift gears to our economic outlook and implications with a focus on kind of the demand segments and the factors that we're really focused on for the major demand segments. So let's start with corporate transient. The big thing that we are going to talk about with corporate transient is really tied to return to office. return to office is not the end all be all for corporate transient. But the reality is, if people aren't in the office, people aren't traveling to go see those people in the office. And that has an impact on corporate transient demand. Corporate, 3 months ago, we sat here on this webinar and said, hey, we might be reaching an inflection point, right? There's all these companies that are supposed to go back to the office. And if you look at some of these headlines, September 11 from CNBC, 90% of companies say they'll return to the office by the end of 24. Return to office battle just hit a tipping point from Market Watch. You see a lot of headlines pointing to the positivity of return to office. However, if you look at Castle data, and Castle data is not the end all be all for return to office. Castle data is very skewed to major markets and high security buildings, which is not every corporate building there is by any sense. So it's not necessarily it's not a broad-based indication of corporate office, just of a specific sector. But of that specific sector, we basically haven't seen any growth, right? We've been hovering around that 50% level basically for a year. It hasn't really changed. And that, is the challenge. We're not seeing that lift from corporate, that lift for return to office, like we all hoped we'd start to see maybe after Labor Day. That data hasn't really materialized. However, if you look at this recent survey from Resume Builder, where they surveyed almost 900 executives related to return to office, they estimate that about 50% had returned to office in the capacity that they were comfortable returning to the office. Which again, I think that doesn't mean 5 days a week, but that's more of a hybrid type dynamic. But they think that survey said another 39% are going to return to office by early 2024, with the remainder with 8% in 2025 or later. So the good news here is that you're going to continue to see a gradual increase in return to office. Is there this massive wave of return to office coming, like I think some of us had hoped for, back in August and September? I think the answer is no. It's going to be relatively gradual, and it's not going to be 5-day-a-week returns. It's going to be hybrid. And as we deal with hybrid return to office, that limits the amount of days people are going to travel for corporate transient demand, which will weigh on corporate transient travel in general. But there's just some interesting data points that highlight some of the challenges, but also some of the upside opportunity there related to corporate transient. We generally think corporate transient will continue to grow from the level it's at today, but we're not seeing this wave of demand coming either. And then, when you think about corporate profits and stock market, these are factors that we pay close attention to, especially as it pertains to corporate transient demand. Corporate profits are projected to decline 5% this year and another 3% next year. But they're still going to be 20% above 2019 levels in 2023. As we just talked about, corporate travel is not back to 2019 levels. So despite these declines, it kind of still feels like there's upside related to corporate travel, and profits aren't going to be a limiting factor for growing corporate transient travel. The stock market, the same type of thing going on here. Yes, the stock market was down 19% last year, but it's up 19% year to date this year through the end of November. And in fact, the S&P 500 is 41% above 2019 levels. So while some of these metrics might indicate a pullback in corporate travel, in corporate transient demand, that would be off of a normalized level of corporate transient travel, which, as we all know, we have not been on in a normalized level. And that's why we're going to continue to see corporate transient travel tick up. We think headwinds are abating for corporate transient travel, and we'll expect to see continued recovery. But again, it's going to be gradual and not overly aggressive. When we think about group, we track 30 of the largest convention centers across the U.S. And of those 30 convention centers, you can basically see where group pacing is on a year-over-year basis. And in the chart here, bottom line is 2023 is pacing up 17% and just slightly below 2019 levels this year. Very strong from a group perspective. 2024 convention booking pace is up 3% on a year-over-year basis. So we've got continued strength in convention bookings. What's really interesting is in June, that was down 11%. So we've moved from down 11 to up 3 in 6 months. which means there's plenty of appetite for convention bookings. And that is encouraging, and it means that that number might even continue to go higher. Some of the best markets for convention performance in 2020 in 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 2024, Minneapolis, San Jose, some of the worst markets, Houston, San Francisco, Salt Lake City. Moving on to the consumer and leisure travel. A couple of things that I'll highlight are trying to get the Zoom bar has frozen on my screen, unfortunately. Let's just move that up there. So signs point to a shifting U.S. consumer, or a softening U.S. consumer. Let's talk about this a little bit. And this points to our concerns over leisure travel, which is something that I think a lot of you have probably seen over the past few months related to hotel performance, especially in resort markets. But the November Consumer Sentiment Index dropped 2.5 points to 61.3. It was the fourth consecutive month of decline. The November Consumer Confidence Index fortunately ticked up 2.9 points, but that was after 3 straight months of declines. And the consumer's assessment of current business and labor market conditions ticked down. Additionally, the Consumer Expectations Index by the Conference Board remains below 80 for the third consecutive month. And that's a level that has historically signaled a recession within the next 12 months, or at least a consumer recession within the next 12 months. We're not saying that a recession is coming, just there are concerns there. Deloitte's Consumer Financial Wellbeing Index dropped to 90.1 in October. That is a continuation of a clear downward trend since April. The other thing that's kind of interesting within Deloitte's survey is they actually break down different leisure components between restaurants, leisure travel, electronics, clothing, apparel, personal care. This top line here is leisure travel. Leisure travel far outpaces everything else. So people are more willing to spend on leisure travel than they are to spend on electronics or clothing or personal care. All of that is great, but leisure travel just ticked negative, which is not great. So as you get the idea here, the consumer is facing difficulties, and those difficulties, we are somewhat concerned about. You layer in the personal savings rate, which is something that we talk about a lot because it's something that we pay close attention to in our forecast models. The personal savings rate, historically, as people are saving more, they're spending less. As people are spending more, they're saving less. In fact, the average personal savings rate and the spend on accommodations and food service or share of wallet, there's a negative 86% correlation between the two. Basically, as one goes up, the other goes down, and vice versa. And that's an important thing to keep in mind. Going forward, when we think about how things had pent up, coming out of the pandemic or during the pandemic, savings really ticked up because people, A, didn't spend any money, and B, received a lot of fiscal stimulus. Then they spent all that money and savings went down. And, while they spent more money on accommodations, and then going forward, personal savings is forecasted to continue to gradually rise. And that is likely to weigh on domestic leisure travel. Now, I say domestic for a reason. There is a silver lining to the leisure travel dynamic, and that is what we refer to as international upside. Now, we've got some really great data here that I'm excited to share with everybody. And this is data from the U.S. Department of Commerce, updated through October. Basically, year-to-date through October, foreign inbound traveler volumes are down 17.5% versus 2019. Okay, so there's a lot of upside still to come from that, right? Importantly, volumes have gradually improved, right? That pace versus that relative to 2019, we've continued to narrow that gap. You're seeing improvements. We started in January, we were 24% below 2019 levels. And then in October, 12% below 2019 levels. And we think that's a clear trend that's going to continue to improve, which is encouraging. On the flip side, international outbound, that's U.S. citizens traveling abroad, traveler volumes are up 9.7% versus 2019. So while international hasn't recovered, domestic going away has. That's kind of a double whammy, right? So domestic have gone abroad, and international hasn't come in. And here's actual data to support that, which many of us already may feel like we know, but here's the data behind it. You know, interestingly enough, momentum's been particularly strong for this international outbound, with September and October the strongest months of the year relative to 2019 levels. Now, the good news is elevated levels of in 2023 should create softer comparisons for U.S. hotels related to domestic leisure in 2024. The bad news is that trend line, with these two being the strongest months of the past year, isn't as encouraging as that. But we certainly see upside from international travelers by month relative to 2019. So as we think going forward, what's going to happen? Well, one of the things, it's not the only thing that drives international travel, either U.S. travelers to go abroad or foreign travelers to come to the U.S. But one of the factors that is very relevant is the value of the U.S. dollar. And one of the things that you'll see is that the U.S. dollar was rising pretty meaningfully, basically through 2022 and the first, and really through 2023, just the pace of that rise started to slow through most of 2023. Well, when the dollar value increases, U.S. destinations become more expensive for foreign inbound travelers, and international destinations become more affordable for U.S. travelers. And what have we seen during this period? International travel has not recovered to the same pace as international inbound has not recovered to the same pace as domestic outbound or U.S. citizen outbound travel has recovered. We believe foreign exchange rates are a big component of that. However, going forward, we see, Moody's, I should say, sees foreign exchange rates to decline, and that decline is going to persist through 2025. That decline is going to trough in the middle of, in early 2025, but decline through 2025. And when the dollar decreases in value, U.S. destinations become more affordable for foreign inbound travelers, and international destinations become more expensive for U.S. travelers. So that is a tailwind for leisure travel, especially related to domestic leisure travelers staying in the U.S. and foreign travelers coming to the U.S. So given that outlook for foreign exchange rates, that's pretty encouraging, should point to those trends potentially reversing from what we've seen over the past year, where we're going to see international grow at a faster pace than international inbound growing at a much faster pace than domestic outbound. And maybe domestic outbound starts to wane, and if that happens, that's even more positive. Now, not every market is going to be created the same. Here's really interesting data that walks through the markets with the greatest exposure to foreign travelers. Now, what I want to say about this data here is when we say Miami 44%, we're not saying 44% of total demand in Miami is from foreign nationals coming into the U.S. What we're taking is the number of foreign travelers that go to Miami as a percentage of total demand in the market. Now, the reality is there's going to be a different length of stay for foreign nationals, and not everybody is staying right in Miami. Maybe they're going outside of the market, et cetera. But it's a good gauge of which markets have the most exposure and which markets have the least exposure to foreign inbound travelers. And what you can see here is Miami is clearing away the strongest, right? They have the most exposure. And then you get a bunch of markets in the 20s, whether it be Honolulu, New York, San Francisco, Fort Lauderdale, and LA. None of those should be overly surprising. And then you get a few a little bit lower, including Boston, Seattle, Chicago, Dallas, et cetera, gradually ticking back down all the way down to Pittsburgh, Cincinnati, which don't have a lot of foreign traveler exposure. Now, while this is interesting, and this says, hey, these markets should see the most growth, and these aren't going to benefit so much. The flip side of that is the pace of recovery to date. And that's what we're going to show you here with the 15 largest. Now, as we look at these 15 markets with the most exposure to foreign traveler volumes, interestingly, Dallas has already recovered. to 2019 levels. So there's probably not that same level of upside in Dallas as we might see in Honolulu, which is still 50% below where it was in pre-pandemic levels, from 2019. Interestingly, one of the things that we think is worth highlighting is look at this group in the middle here. I would have expected Miami and New York to have recovered substantially more than a lot of other markets because those markets have performed particularly well relative to 2019. But that isn't the case. There's still a lot of upside. And I would have thought that San Francisco is a market where we would have been closer to down here. But that's not the case either. San Francisco has recovered almost as much as New York and Miami in terms of foreign inbound travelers. So the idea that San Francisco has more upside from that than New York or Miami, I don't think holds water. I think these are all in the same boat. Don't get me wrong, they all have plenty of upside. It's just not more, if you will. Same thing with Orlando. Now they're a little bit further along, but still not to the same extent as you might see with a Honolulu or an LA as an example. So really interesting data points to kind of point to which markets have the most upside over the next year or two related to foreign inbound travelers. Now, as we look at our economic outlook, these are some of the primary factors that we look at as we evaluate our forecast models. As you will see, real GDP growth is expected to moderate, drop to under 1% in the fourth quarter, and then really be muted throughout 2024. Job growth is going to become really anemic in 2024. Unemployment rate's going to tick up. Inflation's moderating. Corporate profits are negative. Consumer confidence is negative in the fourth quarter, but then the outlook is that it actually might tick back up, which is encouraging for 2025 leisure travel. Foreign exchange rate, as we talked about, will moderate, and then 10-year Treasury yield is going to peak. We think it already peaked in October or November this year, and is going to gradually moderate as we go through 2024. And now some of the assumptions that drive our outlook. Fed's rate increase cycle is over. Cuts will begin sometime in the middle of 2024, and inflation is going to moderate, as we just showed you. We do assume a 2-week government shutdown in the first quarter of 2024, but the federal government will avoid a debt limit breach. Conflicts in the Ukraine and the Middle East will not escalate to include military involvement from the U.S. or the rest of Europe. And there's no near-term U.S. recession, though 2024 economic growth will be very sluggish, as I just kind of showed to you. So with that, let's jump into our lodging out. So we just walked through all the factors that are kind of driving our views on the 3 core demand segments from corporate, transient, group, and leisure. When we think about corporate transient, our view is that corporate transient is going to continue to tick up in 2020 through the remainder of 23 and 2024, but it's going to ultimately, stabilize around 10% below where it was pre-pandemic. Group, on the other hand, is going to continue to tick up. We think it was pretty close to 2019 levels this year. It will exceed them next year as it continues to grow, and will stabilize around 10% above 2019 levels. And then leisure, on the flip side, was really, really strong, right? We estimate leisure demand was about 65% above 2019 levels in 2021, just all that pent-up demand from no travel during 2020. Then that moderated to about 40% above 2019 levels in 2022. It's continuing to moderate in 2023, and we think it will gradually moderate in 2024 and ultimately stabilize around 20% above 2019 levels. So at the end of the day, leisure is stronger than pre-pandemic, group is stronger than pre-pandemic, corporate is weaker than pre-pandemic. We look at supply. Supply is incredibly muted. Very, very muted this year, just about 0.5% supply growth. Now, keep in mind that 0.5% supply growth this year is impacted by about 16,000 rooms in New York City that have been taken out of inventory tied to migrant housing. That would put supply growth almost at 1% if you added those rooms back in. So just something to keep in mind. That is having an impact. You're not going to get that tailwind going forward. We've got supply ticking up modestly to 1.4% next year. But again, supply generally remains benign. We're looking at about 1% supply growth on a 5-year CAGR over the next 5 years. When we think about our RevPAR forecast, this is our actual RevPAR model. The dark blue line that you see on this chart is actual RevPAR on a seasonally adjusted basis, provided by STR. And the light blue line is the model that we've forecasted. Forecast that RevPAR today, historically, based on everything we know historically, we are able to forecast it super well based on these primary factors with a 98.7% R squared. For those of you that remember your stats class, 98.7% R squared basically means our model has forecasted 98.7% of all the variability of RevPAR going back to 2000. And then we take that same model and those same drivers, and instead of the actual results for those macro factors historically, we're going to take Moody's forecast for those macro factors moving forward to give us our RevPAR forecast going forward. And that's what you see right there. Same thing for ADR. Dark blue line is the actuals. Light blue line is our model, 98.7% R squared. Drivers are a little bit different, but you get the idea. And ultimately, what you see from our current forecast is we've got occupancy ticking up in 2024 about 80 basis points, ADR up 2.8%, and RevPAR up 3.6%. That's after RevPAR was up 5.5% this year. We are still the most bullish for 2023. Our forecast for fourth quarter of 2023 is 3.7% RevPAR growth. We believe that those numbers are reasonable based on everything that we see from corporate group and some of the data that's already come in. But for 2024, we are not the most bullish. Our 3.6% RevPAR growth is below what you see from STR or CoStar, but above the other guys. And what's interesting is if you look at the difference between us and STR, if you look at the absolute metrics, our 63.7 and their 63.6 is pretty close. Our 160.19 ADR and their 160.16 is almost identical. And our RevPAR of 102.06 and their RevPAR of 101.89 is only 17 cents apart. So we've got very similar absolute metrics. The big difference is we think 2023 grows a little bit more than they do in the fourth quarter. But interestingly, when they put out their latest forecast in November as part of the press release, they indicated they saw upside risk to their fourth quarter numbers, kind of highlighting that, maybe their numbers come in closer to ours. And then if they don't update those, the forecast outlook for year-over-year growth may be pretty similar to what we're at, actually. But this gives you a sense of kind of where we are versus everybody else. Again, we're a little bit more positive this year. We're kind of in the middle of everybody for next year. And then we get pretty cautious in 2025. We're the only ones forecasting a pullback in RevPAR in 2025 before growth resumes in 2026. The other thing that's interesting is we have occupancy peaking over the next few years in 2024, just south of 64%, whereas just about everybody else has it growing further. And again, that's tied to our corporate transient outlook. On a quarterly basis, this year has been kind of interesting. 1Q was really strong, up almost 17%, given soft Omicron comps. 2Q was up just 2.5%, exceeding our forecast of 1.3. And then 3Q was weak, up just 1.7%, missing our forecast of 4%. That was the weakest. That was the quarter that really missed our expectations. And leisure just ended up coming in a lot softer than we had expected going into the year. And we believe a lot of that was tied to the regional banking crisis and the pullback in credit and business lending that occurred in the months that followed. That changed consumer confidence and consumer sentiment. As we talked about before, consumer sentiment really started to wane beginning in April, and that weighed on leisure travel over the course of the summer. Something that we had not seen prior to the regional banking crisis in February, March. But going forward, we've got relatively positive growth this year and an acceleration into the first quarter of next year. Again, these are corporate transient oriented periods. Summer, we actually think things are going to be stronger as we see more international inbound travel coming back. But then we start to see things starting to turn south in the fourth quarter of 2024. And like we highlighted, we have them being negative in 2025. So a little bit more cautious view as we look further out, but certainly a decent growth in 2024. By price class, this is year-over-year price growth by price class. What you'll see ultimately is that as we focus on 2024, growth is going to be strongest in the factors that we've highlighted as being good, right? Group demand's good. Foreign inbound recovery, good. Corporate transient continuing to improve. Domestic leisure continues to wane. Well, what segments have the most exposure to those things? We're looking at luxury, upper upscale, and then upscale and upper mid-scale, while as the lower tiered segments tend to be more skewed to domestic leisure. If you look at that data relative to 2019, I think one of the things that's really interesting that we want to highlight here is that luxury has proven to be the clear winner relative to 2019. The pace to date has been the strongest, and we think it's going to be stronger next year as well. Interestingly, upper mid-scale has also done relatively well relative to the other segments, and we think that continues next year. And that's partly tied to the idea that a lot of the upper mid-scale brands have gotten enough scale that they are drafting under the upscale brands and gaining a lot of ADR, and that provides a lot of upside for some of those brands. On the flip side, the other segments, whether it be upper upscale, mid-scale, or economy, by 2024, we estimate they're all going to be right around the same place in that 13 to 14% above 2019 levels. So just some interesting dynamics as you think about the different pace of recovery by the different price classes of hotels. Now, so before I jump to the next slide, I think one of the things that we really focus on is trying to understand what we've done well and where we've missed and what opportunities remain for us to continue to get better. As a result, we hold ourselves really accountable to our forecasts and we share them with you. We don't just say, hey, trust us. We give you the background, we give you the detail. We're transparent about it. This is what you see right here is our forecast for 2023 as of December 2022, along with everybody else's forecast, CBRE, STR, CoStar, PwC, going into the year for 2023. Now, 2023 isn't over yet, even though it's mostly over. So what we've done, instead of giving you actual results for 2023, we're just showing you the average of everybody's forecasts today, and saying, hey, this is where they were. And at the end of the day, we were optimistic on occupancy. Occupancy missed us by 90 basis points. Again, we talked about why that was. We saw the consumer shift, following the regional banking crisis that really weighed on our numbers. ADR, we were $1 high, and RevPAR, we were about $2 high. Interestingly, there were only two forecasters of all of these that were within 1.5% on both occupancy and ADR. It was us and PwC. And hats off to Warren Marr and the team at PwC. They were. It looks like they will be by far and away the best forecaster for the U.S. for 2023, with their numbers going into the year looking like they're going to be the best. But we feel pretty confident that we were, given we were the only other ones with occupancy and ADR that were close, felt really good. There were some other guys that had RevPAR close, but it was because they missed by a lot on both occupancy and ADR in opposite directions that it offsets one another. That's not that helpful, right? At least not in my opinion. Anyway, so that's where we were for 2023. Fortunately, this is probably on a relative basis the worst we've performed over the past few years. The year before, in 2022, we were by far the closest on occupancy, ADR, and RevPAR with our forecast going into the year for the year. And the same thing for 2021, where we were the closest on occupancy, ADR, and RevPAR. And then at a market level, our RevPAR forecasts at the end of 2021 for 2022 were more accurate than the leading provider in 70% of our markets. And on average, we were more accurate by 1.9 times for 2022. That means that if we missed by 1%, they missed by 1.9. We missed by 2, they missed by 3.8. We missed by 3, they missed by almost 6. You get the idea. That's a massive outperformance. And then in 2023, we're fortunate that we can say the same thing, more accurate in almost 70% of our markets. And on average, we are forecasted to be more accurate by 90 basis points this year, on average. So if we miss by 1, they miss by 1.9. We miss by 2, they miss by 2.9. That's a big difference across all of our markets. So we feel really good about how we're performing relative to the other guys out there. No forecast is ever going to be perfect, and we're the first to tell you that, but we believe ours are going to be the best available to year in and year out consistently. And the reason for that isn't because, I'm some genius or anything like that. Believe me, my team will tell you I'm certainly not. But our approach is sound. And when you have a better approach, you get better results. And the core tenet of our approach is better data in equals better data out. We use only the best data providers. And that doesn't mean that now to an extent, we're going to use our own data. Don't get me wrong. But if there's a third-party provider that we can purchase data from where it's going to make our forecast better, we will do it. And that is and then when we do it, we want to find the best data provider, not just a data provider. So we get historical operating results from STR and CoStar. Do we have historical operating results? Yes. Do we have them for as many hotels as STR? Absolutely not. So it makes sense to purchase that, right? Moody's Analytics is the economist we forecast. We get convention pacing data from the 30 largest convention centers through a data share agreement. Office market data, we get that from Moody's. Supply, we purchase it from Build Central and CoStar, and we scrub the data and import our own layer of detail and hard work to get that to be as accurate as possible. Short-term rental data from AirDNA in all the rooms, historical cap rates from CoStar. What you'll find is that those aren't data providers that we're affiliated with. We've literally scoured the industry to find the best data providers. And when you have better data providers and better data, you're likely to get better results. That's how we forecast. That is our focus. With that, let's move beyond the top line and focus more on profits and value. So we look at profits. The first thing is wages, right? Wage growth, the good news, wage growth remains elevated, but it's moderating. And next year we have it under 3%, and it's going to hover around 3% going forward, which is pretty encouraging. Property taxes are going to continue to increase at about a 4.5% compound annual growth rate over the next few years. And hotel EBITDA will grow about 4.5% this year, and then next year we've got it growing about 1.5%. That's positive, especially with muted RevPAR growth of just 3.6%, but with ADR driving the majority of that and wage growth moderating, there's a slight uptick in EBITDA. But we've got EBITDA turning negative and declining in 25 and 26 before growth resumes in 2027. Overall, in 2024, we estimate EBITDA will be 13% above 2019 levels, which will likely be the peak of this cycle. Let's talk about cap rates, because I think cap rates are something that we spend a lot of time on that our clients are always asking and trying to get a better grapple on. And it's obviously complicated, but at the end of the day, here's how we think about valuation for hotels and specifically cap rates. Cap rates are composed of basically two primary components. One is a base rate and two is a spread between, and that spread is effectively an equity risk premium, right? So your base rate is the cost of the debt and then your equity risk premium, right? Well, that base rate, for the lack of, we're looking at data here that shows the 10-year treasury yield as the base rate, right? And then here's your cap rate. And the gap between the two is the spread, right? AKA the equity risk premium. Well, here's what's really interesting. Since since 2005, there's a 4.2% correlation and a 0.2% R squared between the 10-year treasury yield and hotel cap rates. If you try to smooth the data on a rolling 4-quarter basis, it's a 0.1% R squared and a 3% correlation. There is no relationship between base rates and cap rates historically. As cap rates move, as base rates move, cap rates do not. And as cap rates move, base rates do not, et cetera. Why is that? Well, the reality is when the 10-year treasury yield has historically declined, right? If you think about this period here, 2007 to 2012, 2013, base rates decline during periods of economic uncertainty or sluggish economic activity where the Fed is trying to boost the economy by slashing rates, right? That is the goal of the Fed. We're going to cut interest rates to kind of inflate the economy and support the economy when it's going through challenging periods. Well, when the economy is going through challenging periods, a real estate sector like hotels that are very economically sensitive will have higher risk. So the risk premium expands, AKA the spread. So base rates go down and the spread goes up and the cap rate doesn't change a lot, right? And then the flip side is when base rates are going up, historically, when base rates move higher, it's often because the Fed is trying to pull back on economic growth, right? The economy is too strong. We need to stymie inflation. We need to slow growth so we have a longer runway, right? And when that happens, there's confidence in the economy. The risk premium for a sector like hotels that's economically sensitive can come down. And as that risk premium comes down, that spread comes down, right? And so base rates go up but the spreads come down and the cap rate doesn't move a lot, right? So historically, what we've seen is that those two things actually counterbalance one another. And that's exactly what you see here, where you can see there's actually a negative 92.9% correlation between 10-year treasury yields and the change in cap rate spreads, hotel cap rate spreads going back to 2000, with an 86.2% R squared. And not only do they move in opposite directions at the same time, they move in almost the same amounts. And that's exactly what this is showing by inverting that, that spread. So effectively, what has historically happened as base rates go up, spreads come down in an equal amount. However, over the past 18 months, that certainly hasn't played out because we've been in a period where base rates are moving higher, not because the Fed is trying to limit economic growth, but because the Fed was trying to break inflation. And as a result, there was a tremendous amount of economic uncertainty that breaking inflation was going to lead to a recession. And over the past 18 months, there's been considerable risk. The majority of economists have forecasted a recession in the near term. Well, guess what? Inflation seems to be on the right track right now. It looks pretty good. People don't think the Fed needs to raise rates anymore. Things seem to be stabilizing. The 10-year treasury yield has come down dramatically, about 50 basis points over the last couple of months. And as base rates stabilize, there will be increased confidence, and you will see, I'm not necessarily saying that elevated spreads are going to compress, but they're not going to expand as base rates come down. And that means that cap rates should moderate over the next 12 months, which will be encouraging. So here's our outlook for cap rates. Again, just like the prior charts, dark blue is actual cap rates from CoStar. Light blue is the model that we've built to forecast that cap rate historically, as well as moving forward. 98.5% R squared. Here's all the factors that drive it. And we put it all together to give you our overall forecast. And bottom line, if we focus on this top chart here, you've basically got, 2023, to 2024, you're seeing supply pick up, but also demand pick up. Occupancy is going to grow at a slightly slower pace, but still pretty positive. ADR growth moderates, RevPAR growth moderates, which translates into hotel EBITDA growth declining, but values are actually going to tick up. And that's because of that cap rate dynamic that we just talked about. But we think 2024 is kind of that high watermark for some of this growth. As 2025, as we highlighted before, you're going to see some negative RevPAR growth, et cetera. It's going to pull things down. And looking out to 2027, things are a little bit more muted. How has our forecast changed from last quarter? Supply came down a little bit, again, largely tied to that New York City migrant housing dynamic. Demand growth actually came down a little bit, which led occupancy to come in. ADR right on par with where we've been. But because occupancy is lower, our RevPAR comes down a little bit versus a quarter ago. Hotel EBITDA comes up because of a mix of the mix between ADR and RevPAR improved toward the ADR front, and wage growth continued to come in, and hotel values have come in despite that. And that's because of our outlook for forward year hotel EBITDA and cash flows has moderated considerably. And our values are not just based on in-place cash flows, but they're DCF analysis for our forward outlook as well. So when we think about values looking out beyond 2023, 2024, we showed you the start of this chart earlier in this presentation. If we go moving forward to 2023, we estimate that values will exceed 2019 levels this year, will exceed 2018 levels next year. But interesting, that's kind of, things start to moderate, right? Growth slows. And by year 8, which is 2026, this cycle, which is the dashed line, ends up being right on par with the GFC, with slightly slower growth in the following years, meaning things slightly underperform there after what we saw coming out of the great financial crisis. All right, let's move on to some markets. Now, before we jump into specific markets, and these are the 61 markets that we issue quarterly forecasts on like clockwork every quarter. Before we jump into any specific markets, I just want to highlight a few things. Number one is nationally, you will hear us and any other hotel analyst that wants to get on their soapbox and talk about where the industry is going, talk a lot about GDP growth, right? The reality is, at a national level, U.S. GDP, real GDP, has a very, very strong relationship with hotel performance, whether that be when you're looking at RevPAR or demand. In fact, you look at RevPAR going back 2000 to 2019, 79.2% correlation, 62.7% R squared. Over the past 4 years coming out of the pandemic, 92% correlation, 84.3% R squared for RevPAR. Demand's even higher. So you get the idea here. There is very strong relationship. Now, unfortunately, GDP growth, as we showed you before, is expected to really moderate going forward. That's going to weigh on demand and RevPAR growth as we move into 2024. Now, at the national level, that's what we see. At the local level, that relationship does not hold water at all. If you look at SDR's top 25 markets from 2000 to 2019, that correlation is less than half at 42%, and the R squared of just 17.8%. So very, very limited. But if you look at the more recent period, 2019 to 2023, where we've seen some of those dynamics related to foreign inbound travel and outbound travel, and leisure taking a bigger component of the pie relative to corporate transit and other things that are driven by local macroeconomic activity, you actually see a almost no relationship, a 2.7% correlation and a 0.1% R squared. So my point here is, do not just rely on local GDP or local jobs to forecast what a hotel market's RevPAR or demand is going to be. It does not work. It creates errors. I know that's how other guys do it. I'm telling you right now, it's wrong. More jobs in the market don't translate into more hotel demand. You look at more jobs in a market like the Florida Keys or Kauai or Maui, it has no indication of whether people are going to pay ADRs are going to go higher for leisure travel coming in, because it doesn't cater to the local resident population. Hotels generally don't cater to the local resident population. And I think looking at things from that perspective is very flawed. That's why we build out models specific to each market to make sure they're as accurate as we can. So we look at our markets. This is 2023 RevPAR outlook. The top chart here is relative 2023 over 2022 year-over-year growth. The bottom chart is 2023 versus 2019. So you can see where things stack up relative to 2019. Our top markets this year, which probably shouldn't be too surprising based on what you've seen year to date: DC, Kansas City, Boston, New York, and Vegas, right? All for different reasons. DC, Kansas City, Boston, they were some of the weaker performers coming into the year. So their growth's off a lower base, just more recovery. New York, we talked about declining supply driving things pretty meaningfully there. Las Vegas, we're looking at outsized group exposure and strong economic growth. But relative to 2019, what you'll notice is that they are not the same markets, with the exception of Las Vegas. Kauai, Palm Springs, Portland, Maine, Florida Keys, Las Vegas, they are all leisure exposure with pretty strong pricing power. If we look to 2024, we're going to focus on year-over-year growth here. RevPAR growth rates for our 61 markets. Strongest growth is going to be in markets with outsized exposure to Asian, international, foreign inbound travel, and corporate transient demand, kind of like we talked about before, right? But these tend to be markets that have recovered the least to date as well: San Jose, Seattle, San Francisco. Maui also has the wildfire comp. Minneapolis, very corporate transient oriented. Bottom performers are going to be those that are predominantly catered to domestic leisure demand. Kauai may be the exception here, largely driven by the fact that Kauai benefited a little bit from the Maui wildfires, with people having to change their plans and go to Kauai instead of Maui. So you see some of those dynamics there. As we go further out and look at a 5-year outlook, top chart is relative to 2022, bottom chart is relative to 2019, looking up to 2027. DC, San Jose, Seattle, Honolulu, and Vegas are our strongest markets out to 2027. Again, those top three are among the weakest recoveries through 2022. None of these are our top markets relative to 2019. Honolulu is going to benefit from that recovery in foreign inbound travel. Like we said, you got another 50% upside. Vegas, you got strong group, growing sports tourism, and top-notch economic growth are going to continue to drive out performance. Relative to 2019, Kauai and Maui, Vegas, Sedona, and Palm Beach. You're looking at foreign inbound travel to the Hawaiian markets that are already on elevated RevPAR levels, and then strong economic growth coupled with recent gains tied to leisure are going to help the other markets. So bottom line is that gives you a sense of kind of where our RevPAR outlooks are. Now, as we move to hotel values, our top performers in 2027 versus 2022, which is the top chart, and then versus 2019 is the bottom chart. Seattle and DC, basically weak recovery to date. And then they're obviously benefiting from inbound travelers. Most of that benefit already occurred in 2023 for DC, still has a lot of room left for Seattle. Las Vegas, strong economic growth, sports tourism, growing corporate segment. Dallas, top line growth, modest expense growth, and outsized economic growth. LA, you get the benefits from the Olympics, plus the foreign inbound travel recovery. And then relative to 2019, Phoenix, Tampa, Vegas, Nashville, and Anaheim. It's a mix of outsized leisure exposure, strong economic growth, and modest expense growth. Are going to drive all of these markets to be winners over the long term. Now, as we shift beyond the markets to beyond the metros, we're going to dig into 3 markets specifically. I'm going to talk a little about New York, San Francisco, and Nashville. On the surface, New York has recovered nicely. Leisure orientation has been pretty high. Recovering international travel will continue to support the market, kind of how we talked about that before. But corporate transient is going to continue to improve, but it's growing. The indicators are growing at a slower pace than the national average, as you see here, where New York basically lags the national average in professional services, economic growth, or financial activities, or office employment, or overall economic growth, certainly population. None of that bodes that well for New York's corporate transient to outpace the national average. We think it's going to underpace the national average. And the other thing that's important to note about New York is supply is down 7% from 2019 levels. That is a massive number. It's down 7% despite 13,000 new rooms having opened since the end of 2019 and start of 2020. That's largely tied to migrant housing, with 16,000 rooms coming offline primarily in 2023 for migrant housing. That tailwind is going to dissolve in 2024, and supply growth is going to go from down 2% in 2023 to up 2% in 2024. That is a 4% shift in supply growth, and we think that's going to have pretty big implications across the market, especially as you move into a period where foreign inbound travel isn't going to be quite. It's going to see the same type of uptick that we saw this year. Here's our RevPAR model for New York. Just like I showed you before, dark blue is the actuals from STR on a seasonally adjusted basis. Light blue is our model, 99.5% R squared. You notice our factors are specific to New York. We do include local GMP, but we also look at things like financial services, economic output, retail sales, CPI, foreign exchange rates. Here, this is kind of a snapshot of our LARC GIS application where you can see pockets of strength. The GIS application allows you to really dig in and see where RevPAR's growth is going to be strongest. In this chart right here, we're just showing you a forward 5-year look for RevPAR growth over the next 5 years. But in the tool yourself, you can actually download forecasts for each one of these block groups or any area around any given hotel. It's really, really pretty cool application. But when you see here, what we're trying to highlight is that there are certain things that are going to drive outperformance, whether it be continued growth in Hudson Yards, the Hudson Tunnel project, Penn Station redevelopment, the Science Park, return to office, which should help Midtown and downtown, New York City Football Club, migrant housing taking supply, and Airbnb regulations, all factors that come into play when we think about where things are going to outperform or where they're going to underperform. Moving on to San Francisco, we have San Francisco is heavily reliant on the tech sector and inbound foreign travel from Asia. The other thing that's really important about San Francisco is it had previously strong convention center dynamics, but crime and homelessness have been dampening bookings. In 2019, convention center demand generated 7.5% of the market's total demand. It's a big number. No year after 2023 is pacing within 20% of 2019 levels. We've seen massive conventions decide to relocate to other locations. And most of those losses are attributed to, the state of the safety across the city. On top of that, corporate transient and foreign inbound travel recovery should aid the market. But corporate transient, while it's growing, is not looking like it's going to be growing materially faster than the U.S. overall. Economic growth over the next 5 years slightly lags. Financial activities, professional services lag. Tech outperforms, but tech isn't generating as much corporate transient demand. Office employment lags as well. So you put all that together, it paints a positive picture, but not an exciting picture. San Francisco RevPAR model, like you see here, just like we've shown you before, 94.2% R squared. You'll notice our forecast drivers are different than what you saw for the other facts for New York. Every market is unique. We build models out that are specific. We see upside from here in terms of RevPAR. We even got a spike related to, I believe that's the Super Bowl in 2026. but we don't see things getting back to where we were pre-pandemic. So upside, but not getting back to where we were. And then a heat map across the market. Again, this is from our GIS application. We're going to see strong growth, but off of a low base. Fisherman's Wharf, which has a lot of leisure demand, especially from Asian inbound travel, should be probably one of the stronger performing areas. Moscone Center benefiting from convention. A lot of that's in 2023. And then you also have the Atlas Block expansion over here, which will be encouraging. FX tailwinds will be a nice positive for the market. Moving on to Nashville. Nashville's a market that we hear a lot about as well. Here, the leisure orientation is very robust, but this is not just a leisure city. There's very strong group dynamics. 1.2 million annual room nights generated in 2019 from the convention center. Convention pacing is strong. 2024 is up 13% year over year. 2025 is up another 11% year over year. Corporate transient is a growing sector across the Nashville market. You got 80% more office using jobs today than you had in 2010. And the macroeconomic outlook for corporate transient demand drivers is pretty favorable. You're seeing outsized growth for economic growth, office employment, IT, financial services, and professional services. This is all encouraging for corporate transient. We're going to see outsized corporate transient growth, outside group growth, while leisure moderates a little bit and offsets them. But net, that's all pretty positive. Moving on to our RevPAR model, just like the others, you'll see dark blue is actuals, light blue is our model, 99.4% R squared. And again, the factors that drive this model are different than the factors that drive the models for New York or San Francisco. And then here's a heat map from our GIS application that shows you where RevPAR growth is going to be strongest. I think the East Bank gets really, really interesting over the next few years. You got a lot going on, from the riverfront development to Oracle's Nashville hub to the Titan Stadium development. Obviously, strong group related to the Music City Center. Airport's going through another expansion that'll be completing in 2028. And while supply growth has been elevated, it is moderating, and that is very encouraging. And with that, one of the things I want to say is everything that we've walked throughout, or most of what we've discussed throughout this presentation, is tied to our quarterly market intelligence reports. But we do a lot more than that. Obviously, we put out reports on 61 markets every quarter. We also issue commission forecast reports. Any market, any sub-market, any price class, usually done for budgeting or specific transactions. We can be very helpful. And then last is our LARC GIS application, which really is an amazing application that allows you to really dig into the data behind any location in the country, whether it be an existing hotel or a development site. And we can help you guys leverage that application to really build out something special. And with that, I am going to stop now. Wish everybody happy holidays. And we are going to go to Q&A. And I am going to try to be as festive as I can for Q&A. So with that, Katie, let me know what questions we got.
All righty. Thanks for joining, everyone. The first question is, does Evan Weiss understand what a regression analysis is?
I would probably ask Evan that, but he'd probably punt to me.
Have we entered a new normal where trends and analysis should be compared to prior year versus using a 2019 pre-COVID baseline?
Yeah, I think we're pretty much there now. I think 2023 is that year where we need to be focusing on more 2023 as a baseline as opposed to 2019. But we have to finish 2023 to do that. I think there's still a lot of noise in the 2022 full year data to really do that. But I wholeheartedly agree. You started to see us change that. We've actually warned our clients that starting in March, we are going to do that. So we are on the same page as you.
Does LARC forecast hotel EBITDA at a specific market level, for example, San Francisco?
Yes, we do, for 32 cities around the country.
To what extent might commercial mortgage defaults impact return to office initiatives and, by extension, business travel?
It's a great question. I think in the past, we haven't necessarily seen commercial mortgage defaults translate into a return to office issue. The buildings tend to stay in operation regardless of a default. Will companies, I think from a financial service perspective, walk away from return to office or reduce their office utilization because somebody defaulted on a loan? I'm not sure that we see that. So I don't think that has a big implication on return to office or corporate transient travel. We certainly haven't seen that implication in the past. The bigger concern is, do these defaults translate into a pullback in broader economic growth? which then translates into if corporate profits are going down, and the stock market is pulling back, that will weigh on corporate travel. But the defaults themselves, outside of that domino effect from them, I'm not confident will actually have an impact.
What was the stabilized office occupancy prior to the pandemic? How far off are we on this level in the top 25 markets?
In terms of occupancy versus utilization, I don't have US occupancy data in front of me. I'm not an office professional. Data from Castle Systems for utilization indicates that office utilization is about 50% of where it was in 2019. Now, again, I think Castle Systems data isn't perfect. It's a subsector of the office using industry, those that require card swipes to get into the buildings. So as you aren't focused on those types of secure type buildings, which there's a lot of office buildings that don't require card swipes to get into the buildings. Things change, but that's 50% of where we were in 2019. And I think that 50% is a mix of companies that are in the office 5 days a week, companies that are in the office no days a week, and companies that are in the office 2 or 3 days a week. It's a mix of all of it.
Can we get a copy of the recording and the set of slides, please?
Yes, the slides will be emailed out and the recording will be posted on our website later today.
Why is LARC so confident in its prediction of a 2-week government shutdown? What data points are driving this prediction?
Yeah, I mean, I think it's an assumption. I wouldn't say it's confident. I think we have to make an assumption one way or another. And Congress doesn't seem to be able to get anything across the finish line right now. And all they do is punt and punt and punt. And I think that our new Speaker of the House is going to find a lot of difficulty trying to get something done in January. That is why he punted from November to January to try to put something together. But I think he's going to face a ton of opposition from the right-wing side of his party. And the Democrats have not seemed to be willing to, support any cause for negotiation, if you will.
Looks like corporate demand volume is expected to increase in 2024, but decline in 25. Can you explain why that would be?
Yeah, our view on 2025 is economic growth is going to continue to wane. Corporate profits are going to continue to decline, and we've got a pretty cautious view on where things are going for 2025. It's not just corporate transient; it's RevPAR being down.
I think this is in terms of 2025 as well, but is that pullback due to recession?
We don't have a recession forecasted in the market, but we do have very anemic GDP growth. Recession like GDP growth, though, a recession is not necessarily declared.
What specifically is driving the pullback in occupancy projections in 2025?
Again, I think we're talking about the macro data points that drive our RevPAR model.
Again, with what factors are driving your negative 2025 outlook?
Yeah, I think if you go back, it's the outlook. Our forecast is entirely model driven. So if I go back to our US RevPAR model, which you can see right here, these are the factors. It's the outlook for unemployment rate, GDP, corporate profits, foreign exchange rates, personal savings, consumer confidence, and inflation. All of these primary factors are what's causing this blip right here. And that before growth resumes thereafter. So it's the forecast from Moody's for all of these metrics that drive our concern in 2025.
What are the key assumptions driving the negative outlook for 2025, 2026? Gonna skip over that.
Yes, keep going.
Specific to the Chicago market, did the changes in business travel outlook drive the decline in 2024 occupancy / RevPAR versus the prior forecast?
Let me get back to you on that one. Shoot us an email and I'll be happy to answer in greater detail.
Surprised to see supply is not a factor in Nashville RevPAR forecast. It is included in San Francisco's model. Is Nashville immune to supply growth?
No. So supply is included in all of our models. Just some of them, it has a bigger impact than others. As our convention center bookings, like you don't see convention center, we don't list convention center, we don't list supply in most markets. If you look at New York, we'll include them. Supply, convention centers. We don't list everything. We list the factors that are the most that drive most things. Supply is an impact, but it's not it's not a huge driver. Convention center is an impact as well, but it doesn't have the same level of driver. So we won't list every factor that drives our models. We'll list the ones that drive the vast majority.
What is your opinion on the outlook for the Salt Lake City market? How convention reliant is this market, perhaps relative to San Francisco?
It's convention reliant. It just went through an expansion of sorts with a new convention center hotel. Excuse me. I'm gonna take this off. That's making me warm. So it does have some convention reliance. Salt Lake City, we think that 2024 is going to be a challenging year for Salt Lake City between the convention center and an elevated level of performance to date. It faces really tough comps. We think it'll push through that, and over the long term, we like Salt Lake City, but in the short term, we see some challenges.
Could you include more loan structure / investment data in your webinars?
I'll think about that. Thanks for the suggestion.
Where can I find your shutdown analysis?
Where can you find what analysis?
Your shutdown? I'm guessing referring to the government shutdown.
We don't have any specific analysis tied to it. It's an assumption that Moody's has that we've got built into our numbers.
And that was the last question.
Okay, great. Well, look, thank you all for joining. I'm going to stop the share here. If you have any questions or anything we can be helpful with, please don't hesitate to reach out. And from all of us at LARC, happy holidays and enjoy the season. And we look forward to hearing from you. Thanks a lot and have a great day.